are very happy to be here. My name is Diego Lucero. I come from the European Investment Fund in Luxembourg. As you may or may not know, we are one of the European institutions. We're part of the European Investment Bank Group, the bank of the EU. And we are specialized in risk finance or risk lending, high-risk lending. So we are the arm of the EIB group that deals with riskier transactions in the sense that we have equity markets and guarantees, debt financing, for mainly for the benefit of the European SMEs. So how we work at the EIF is via a delegated or intermediated model. So we always partner up with public institutions, public financial institutions in different countries. We're active in all of the European Union and some other countries outside of the European Union. We partner up with financial intermediaries, financial institutions, public agencies, and also fintechs. And we have put together for you today a panel. We have 4 financial institutions that are covering different markets. And we're going to showcase today to you what are the possibilities in terms of finding public-backed finance in the market. What are the tools, the resources out there, so you can be beneficial for your businesses, or in case you are a fintech, also how you could partner up with institutions, European institutions, to channel those very necessary funds to the European SMEs for different sectors, key sectors. We've been speaking in this conference very much about innovation, digitalization, sustainability. We're also going to be speaking about education linked and as something very, very important for innovation. We cannot have more innovation in Europe without the necessary skills. So give it up for the 4 financial institutions that will be represented today. And we start, please, guys. So thank you very much. It's a pleasure for us to be moderating this panel this morning. Thank you all of you for being a part of this. In the introduction, I was telling the audience that we're going to be speaking about public financing, tools to finance mainly SMEs in Europe, businesses in Europe, which is very much needed. We were speaking in the conference about the current situation in terms of geopolitics. We're speaking about the need of financial markets, the banking market, the alternative lenders market, and how much it is needed to have also public support for different sectors and segments of the economy. For example, everything which is linked to sustainability, innovation, and education as well. So we have a great representation today of 4 financial institutions, very different amongst themselves. They're targeting different types of business with different products, and they will be able, I hope today, we will together be able to explain what we are doing, each of us from our financial institutions, and how we are trying to support the EU economy, fintechs, and small and medium-sized businesses, startups, scale-ups, small caps. Okay, so with that being said, let me start. I think for context, I think it would be great if we can just hear like a short introduction from each and every of our distinguished panelists. Maybe we start with Alexander from KfW. I think KfW doesn't need an introduction, so this is why we're starting with you. So if you can very briefly introduce yourself and tell the audience what is specifically your mission within KfW, that would be great.
Yeah, thank you very much. And I'm Alexander. I'm a member of the management board of KfW Capital. It's a subsidiary of KfW, the large promotional bank in Germany. And we are in charge of venture capital investments. We're a fund investor, and we're on the market for more or less 6 years now, 6 to 7 years. And in the meantime, we have built a pretty well diversified portfolio consisting of more than 130 VC fund investments, and I'm very happy to join the talks. Thanks for the invitation.
Very good. Thank you so much. Thomas?
Thank you very much. I'm responsible for product development and European affairs at Investitionsbank Berlin. It's the regional development bank of the Land of Berlin. We are promoting business development, affordable housing, and the transformation into a sustainable and CO2-free future of the industry. We are focusing on SMEs, on startups, including Fintechs, supporting them with loans, with mezzanine capital, with venture capital, but we also administer some grants by the government. Our main objective is, on the one hand, to ease access to finance, but on the other hand, also to incentivize investments in areas that are of public interest. Very important is that we are not in any competition to the private banks or private investors. We are cooperating with the private actors in order to leverage or crowding in private investment. That's very important. I mean, there are some areas where there's a clear market failure, such as microcredit or very early stage risk financing, where we are on our own. Yeah. We're doing this as actively as co-investors with enterprises. We are also passively our grantor, and we're using private banks as a partner, as intermediaries to channel our promotional loans towards the final recipients.
Very good. Thank you very much. Ignacio?
Thank you very much, Diego. It's a pleasure to be here in this panel. I'm Ignacio. I'm the CFO of Bcas, and Bcas is a startup based in Spain, which provides sustainable student financing solutions. We operate a very distinct financial product called income sharing agreements, which is unlike a traditional loan that you can get from a bank. And the way it differs from a traditional loan is that we pay up front for the tuition, and students only pay us back once they graduate, they find a job, and earn beyond a certain income threshold. We also don't ask for collateral, nor guarantor, nor source of steady income. So we basically analyze the probability of employment of our students. And last year, we had a very big milestone where we closed a guarantee line with the EIF, and that is one of the key reasons why we're here in Frankfurt today. Thank you.
Very good. Thank you very much. And Maite, please introduce yourself.
Thank you very much, Diego. Thanks, Corina, for inviting us to be part of this event. Basically, Banco Santander is a Spanish bank working a lot with companies. 3 out of 4 companies in Spain work with Banco Santander, but we have more than 4 million customers, SMEs worldwide. We are aware of the fast-changing world we are at the moment in, and the challenges the SMEs are facing. You mentioned some of them: sustainability, digitalization, attracting and retaining talent, scaling their businesses and be productive and relevant. This is why we created Santander Growth 2 years ago, with the purpose of fostering sustainable growth of SMEs. There we have a talented team across different places in Spain, in 11 different points, with a client-centric approach, offering those clients our best products for each one of the phases in their growth, depending on their growth stage they are in. So we're helping startups with venture debt, venture capital. We have different funds, Fondo Smart, Tres Mares, offering direct lending, even equity solutions, and then all our global capabilities to help businesses grow and scale faster. There, our collaboration with public collaboration is key. In some of their businesses, we are trying to accelerate, and we're very happy to work with you, Diego, in many of the guarantees we are signing, and at the moment increasing to continue growing and even speed up the rhythm.
Very good, very good. I don't know about you guys, but I'm very excited about this panel. I mean, these guys are amazing. We have, for context, so we wanted a representation of public institutions. We're three public institutions and 2 private institutions. And as the panelists were saying, here the important message is that we're blending together. We're trying to make public finance go to the actual businesses for growth in the sectors that we're saying, and to actually support the economy. So we wanted a panel that represents the public sector, the private sector, and how we use public-to-public collaborations and public-to-private collaborations to try to bring financing at competitive costs or investments as well, because we're also representing the full, let's say, cycle in the sense that we're covering the debt products, so liquidity for companies, investment loans, up to capital, investments in capital. And let me start with that, Alexander, maybe because you're also representing let's say, the private equity investments. Could you please give us a little bit more context on how KfW is using this product to support the market, to crowd in private investors into the market? How does it work? For maybe some members of the audience are not used to how we're operating, and could you briefly explain your activity and how also it's very important for the economy and required in order to bring some private funds into the actual companies?
Mm-hmm. Yeah, thank you, Diego. It's a very important question. Maybe regarding the sectors we do invest in, of course, the first thing to mention is that we have specific facilities to address issues like, for example, green tech. We, just to give an example, we launched a facility consisting of 100 million euros, and within 1.5 years, we invested in many green tech funds. So this is called the Green Transition Facility. So this makes sure that the money we invest together with private investors, I will get back to this later, is flowing into the green tech sector. Apart from this, it is, I think, worth to mention that we are sector agnostic regarding our investment philosophy, which results automatically in a strong contribution of, for example, climate tech. I just checked our figures. We have, I think, more than 20% of our fund portfolio consists of funds investing in climate tech companies. And so overall, we have more than 300 climate tech startups within our portfolio. Wow. So these are specific issues. So we have commitment on climate tech, we have commitment on impact, and I want to make clear that our commitment remains also in these days. So this is the first thing you mentioned. The second thing was the invitation of privates and how does it work, the cooperation. So I think in this context, it is very important to know that KfW Capital invests only in funds which have at least 50% of private investors. Okay. So, of course, automatically we do not invest alone, and all our activities involve private capital. And the most important thing is our mission, of course, when you asked about our mission, is to further develop the venture capital market in Germany, especially, but also in Europe. For this, it is important to have strong players, strong public players. It is not surprising that I say this, because KfW Capital and also the EIF, by the way. But most important is that we increase the private capital in our asset class. And this is why we have this investment strategy. A lighthouse project was a so-called Wachstumsfonds Deutschland. We were more than proud to launch it at the end of 2023. The total size of the fund is more or less 1 billion euros, but 70% of it came from private sources. And in the meantime, more than 50% of it is deployed in venture capital funds. So this is also important. When you want to invite or want to provoke that more private capital flows in venture capital, the most important thing for public investors is to show performance. Because in the long run, no private investor invests if there's no performance. So you have to know that KfW Capital's activities are all based on the proper and, yes, demanding due diligence. We want to be a kind of lighthouse investor. So this makes sure that funds we are investing in is also joined by private sources. So these are a few comments on our general investment philosophy and the way we try to increase private capitals.
That's very good and very clear. So this is a clear example on how public funding can support a full industry and how companies in Germany, in this case, can benefit from private equity investments, and how by mobilizing public funds, Alexander and his team are achieving leverage, which means that they're crowding in private investors investments, sometimes one-to-one or even more than one-to-one, from €1 of public spending or investment, let's say investment, because it's not spending, they're crowding in more than €1 of investments that would not be there without these type of schemes. So this would be funds that would not be, let's say, they could maybe not exist, or they would not be investing in real companies. So this is why this leverage is so important as well, and it will facilitate investments in a lot of companies that are viable, but for which, without the public support, there might not be a market, right? So now we changed a little bit the product and the approach, but maybe Thomas, maybe you could do the same. Maybe can we go a little bit more deeper into how you collaborate with partners in order also, in your case, I think it's more financing?
Yes, we have a couple of financing approaches where we cooperate both with the private sector, but also with other public financing institutions, like on the European level. I think our most successful financing vehicle is our venture capital funds from the IBB Ventures. We are the most active venture investor in Berlin. At the same time, we have a leverage rate of 1:6. So we have financed about 270 startups in the last 20 years with up to €300 public money, and the total investment volume we managed with the private partners was up to €1.8 billion. And half of this public money is European money, but we also apply the cooperation model for the classic debt or loan finance. We have the for many years, actually since 2011, we have guarantee agreements with the European Investment Fund, helping our loan programs that are particularly focused on innovative enterprises, innovation projects, or startups that are very high risk. The idea is to take over part of the risk from the commercial banks, for example, increasing the ability or willingness to finance more riskier enterprises. But we have, as a public bank, we have also the same procedure when we make financing decisions. We have risk limits, etc. So also expanding the risk sharing with another public partner like the European Investment Fund leads to further de-risking and hopefully also more private investment.
Very good. Thank you so much. Thank you so much. Another good example, and in this case, Thomas was mentioning their partnership with the European Investment Fund, in which the European Investment Fund, as a supranational, as a European entity, is supporting indirectly, in this case, the German economy, the investments in German companies via a guarantee agreement, a guarantee partnership. Of course, EIF could not exist without our partnerships with financial institutions that are the real institutions that know the ground, know the economy, the local economy, know the companies, and of course they can analyze and discriminate the businesses. So this is a public-to-public collaboration scheme, very successful, working with this institution very successfully, and it's a very good example in how we channel funds that, in the end, for the ultimate benefit of the businesses and the companies. So this leads me to another example. In this case, I'm going to skip Ignacio and go to Maite, and you will understand why. Because I would like to see the perspective of a purely commercial bank, let's say, in this case, more focusing on the Spanish market, Santander. Maite, can you tell us how the collaboration between Banco Santander with a public institution such as EIF has been hopefully adding value to your business, or has been changing your approach to underwriting transactions, to lending to businesses? Can you let us know what has been your experience and the keys that you extract from this?
Okay. Thanks, Diego. We are working with the European Investment Fund, but also with all the local public banks, of course, and we are #1 in market share in distributing the products available, such as liquidity products and guarantee products, right? With EIF, we have a long-standing relationship, and we are heavy users of your guarantees, which of course help us a lot in speeding up our business for startups and SMEs, where your help is being crucial in being able to accelerate our business. In Santander, we have a fund called a Smart Fund, and there we are using InvestEU since we created it, and then since 2023, when you launched in the other one, InvestEU, we are using that guarantee, and now we are in the process of increasing it with an additional 300 million. That means that we already used, with the pipeline we have right now, 200 million, and this is to cover around 80% of what we lend in the projects that meet your requirements to speed up digitalization and sustainability. So for us, it's been crucial in accelerating the SMEs lending activity, and of course in speeding up those two very important and strategic movements, digitalization and sustainability inside the SMEs in Spain. And now, as you know, we are also starting to use it in our startups business and in the funds that we are creating to also speed up lending for scale-ups and startups. So it's been crucial. It's very useful because we reduce our risk, of course, but also we can offer better pricing for companies with a lot of risk. And that, of course, accelerates their activity, and it's very important for us.
Very good.
So thanks, Diego.
Thank you very much. I'm going to highlight a couple of things that Maite has said that resonates, and just to break them down further for the audience. So one is that Santander is a private bank. Of course, they're financing businesses as part of their activity. But when partnering up with a financial institution such as EIF to obtain a guarantee in order to be able to lend more and at better terms, there's some eligibility criteria. Of course, the public schemes come with strings attached, in the sense that they're there to support a specific type of final recipient, typically small to medium-sized businesses, depends from program to program. And of course, for those verticals or those sectors that are more strategic. And Santander was, for example, explaining that for them, they're using the guarantee more for the segment, it's growth, it's Santander growth. So it's for all of the companies that are either startup or scale-ups and are growing fast. Without the public support, most likely a commercial bank such as Santander, for the risk appetite and sometimes the lack of collateral and guarantees of these startups, they could not finance that loan book without the public support. And thanks to this, Santander has been successfully deploying this for the past many years. Maite was giving some statistics on how their lending to this segment, specific segment, has increased thanks to the guarantee. So another example of successful collaboration in the end for the benefit, in this case, of startups, scale-ups, and high-growth companies. Very good. And then we reach Ignacio. Your case, it's a little bit different in the sense you're also a financial institution, but maybe a different one or specific one. You're technically a fintech. You're lending also in Europe, and your target group is students and learners, which is a little bit specific. Can you, Ignacio, please just tell us what is your experience? I mean, describe maybe the project a little bit more in depth. And if you can tell us what is also, if this has been, what has been the key things from working with institutions such as EIF, the public to private collaboration in this case, how this has been helping you, what kind of results are you achieving with this type of collaboration?
For sure. Thank you very much, Diego. So at the end of the day, Bcas is an alternative lender, right? Like, we're in the financing business, and we finance students. What do you need to finance students? You need capital. As a startup, as many of you will know, it's really hard to raise capital, especially when you have a brilliant idea in which you're going to give out a loan to a student, and you're only going to get the money back once they find a job and with a percentage of their salary. So it's sort of like funky instrument. It's really cool, but it's really hard for it to take off, right? Why is it really hard to take off? Because of the access to capital, right? The first credits that we had access to were not very flexible. They were obviously very, very costly and not very efficient in terms of the asset and liability mismatch, right? But with the support of the EIF, we've essentially secured a first loss layer for our credit lines, which has enabled us to access capital at much more favorable conditions. And in turn, that has increased the volume of the capital we have access to. It has increased our level of deployment substantially. Just to give you some numbers, we closed the EIF partnership in May 2024. And in tandem, we were closing our credit line with one of the top Spanish players. It wasn't Santander, unfortunately. maybe
we
next time.
We have to change that.
Maybe next time. But yeah, since we closed that line, we've financed over 7.5 million euros in Spain and a small pilot in Germany, which is exactly the same amount that we had financed in 21, 22, and 23. So for us, it has really enhanced our capital deployment capabilities, and additionally, it has allowed us to strike the right balance between rapid growth and default containment. As a lender, like it's probably not what the SaaS venture capital people wanna hear, you know. But as a lending business, it's really hard to grow at 100x and make the company sustainable and to last in the long run, right? So for us, it's always it's really important to deploy capital, but deploy it in a way that we are ensuring that we're gonna get it back, right, for sustainable growth. And we've been able to unlock access to capital and sustainable growth with the help of public financing, like the EIF.
Thank you very much. So what Ignacio is saying, I mean, this is a different example, but it can serve you to also understand the possibilities. So Bcas is a young financial alternative finance company, fintech, and their issue was more, I mean, they're targeting a specific niche, which is students, for which there's maybe not a lot of appetite when you're trying to raise financing from investors. You need to fund the operations. Okay, they're a young company. They were a startup. They're growing so fast, and their main issue here, they had the book to lend. There's the appetite. There's the product. The product is very good. It's very flexible for students and learners. So they had the capacity to underwrite and to lend in different countries, but they were lacking the funds to do that, and their problem was the bottleneck, that they could grow very, very fast, but for that you need to support the liquidity. So in this case, the collaboration with EIF in this case was crucial for them in allowing them to grow, to get the funds from the private market, from private investors, to channel those funds to students and learners. So happy to hear this story and that these guys are growing so fast. So we go back to Alexander, and now we change again to more the equity and private equity investments. Alexander, we were discussing again before and how important this is, your programs in particular, to unlock private financing in private equity funds. And we were speaking about the leverage and the use of public funds to channel to those fund managers and funds. Can you tell us a little bit more about how you work with your financial intermediaries? How do you select those funds? What are the main eligibility criteria?
Yes, of course, as I mentioned, our decisions are made based on an intense due diligence process. Maybe a little bit about how this works. In general, of course, we have a management presentation, so the team, the fund management comes to us and presents its story and its pitch deck. And then very important part is an on-site visit at the management, so we travel a lot to Berlin, Munich, Barcelona, and so on. And because we want to visit the teams in their offices. Why do I mention this? I think apart from some quantitative assessments we do, of course, we check the track record of the team in previous fund generations, or the individual track record of the fund managers. But at the end, this is people's or team business, and I think a panelist yesterday talked about Paris Saint-Germain, football club with fantastic players, but he said that the team at a whole, the performance is weaker than the simple addition of the individual players from time to time. And I think if you transfer this to the fund management, of course, the team spirit is very, very important. So they have to cooperate well. There shouldn't be too much tensions. The incentives have to be set well. Maybe I should explain a typical incentive scheme in a venture capital fund is a so-called carried interest, which means that if the fund management has made a certain return and all the excessive cash flows, the fund management participates usually on the level of 20%. And this is, of course, very important for the fund management because they have incentives to perform well. And we really like it if this carried interest is not only for the GPs or the general partners, but for the whole team. So the whole team is incentivized. This is very important. Of course, we pay attention to the terms and conditions. So the management fees, this shouldn't be too costly. And the so-called GP commitment. So the GP should have a stake in its own fund. This is also important. It shouldn't be too low and it shouldn't be too high. If it's too high, of course, we pay attention to the individual financial situation of each guy there. So we often get the question, how large should this GP commitment be? And the simple answer is it is based it is case by case. Apart from this, because we're talking about startups here, I think many funds are a startup in themselves, especially if they further develop what they often do. I should say, when we talk about financial assessments, of course, we have some funds which are in its 9th or 10th generation, but a significant part of these 130 funds we have in our portfolio are first or second-time funds. So these funds do develop, and they have to. We like it if they have the ambition to further develop, but they should also be aware that there's a development. So sometimes we face a situation that the fund said, okay, our fund volume is double-sized, but our strategy remains the same, which does not really work. So this is also very important. And the last thing I want to mention is, of course, we have close attention on how we cooperate after signing. Of course, we like to receive good news from our funds, but we like it also if there are bad news, and this happens if you invest in many startups. So transparency is very important for us. And so, of course, if you see, that's a very complex process. And at the end, we are happy to say that our investment process is selective. We have significant more opportunities than we make final investments.
Very good. No, thank you very much. This was, I love how eloquently Alexander put the difficult art of investing in equity funds in a very, very short time, because here there's some keys as they're dealing many times with he was saying it, new funds or new teams or second-time teams, so they're very, very young. So it's very tricky to how do we analyze these transactions? And just to highlight 2 points. One is the experience of the team, how they work together. This is very, very important, especially for new teams, which is more difficult to select. And then the alignment of interest, right? The alignment of interest as KfW as an LP. There's they need probably to ensure an alignment of interest with the investment team. Those are very key areas when selecting, let's say, investable funds. But thank you very much for that, because it was very, very clear. Thomas, I think we don't have a lot of time, but I would like to hear from you if you would be so kind just to maybe to let me know and the audience know how because of course we're partnering up with you in the guarantees. If you could give a little bit more visibility in how this you have been using these guarantees, if these guarantees have been, let's say, somehow changing how you approach underwriting risk, if you were able to expand volumes to what is the point of having the guarantees and how you've been utilizing them?
First of all, we are sort of outsourcing the customer care. We are using all the partner banks in Berlin to have the first contact to the enterprises, to the SMEs, to the startups, and they have their first investment decision, and then they come to us, and we make our own risk assessment. But as I said, with sharing with you guys, it's possible for us to actually have higher volumes of loans, to go into riskier projects, focus more on also on EU level objectives like innovation, like sustainability, all investments that are maybe a bit riskier. We also actually having an advantage for you because you only have one guarantee contract with one intermediary, but as we are working together with all those banks in Berlin, so-called Hausbankenprinzip in Germany, you have lots of sub-intermediaries for the program. So it is also that German public banks, they used to only offer preferential conditions, cheap refinancing, making loans cheaper. They didn't really have a long history of taking on the final creditor's risk. And I think all the options of incorporating EU-level financial instruments sort of kick-started this this approach that we should take over more risk from the banks, and having new approaches, having more programs, and also really having a new focus on like as I said, innovation, but also sustainability and regional authorities. That's a problem. Regional authorities, and we are part of the region. We belong to the land. Regional authorities actually like grants because they can administer themselves, and there has also been a big distrust towards the financial sector and financial instruments after the financial crisis. So actually, the combination of best practice from the European level financial instruments, but also the pressure to apply it, and the knowledge that you could get some European money into a region has actually changed the mind of local and regional authorities to embrace financial instruments, and public development banks have played a big role in sort of make it happen in the regions.
Very good. Thank you very much for that. We're running out of time. One very quick question for Ignacio in 1 minute or less, if it's possible. But we saw how the guarantee program helped like a young company like Bcas, a fintech, to be able to have financing to channel, grow faster. What would you expect from this public collaboration in the future? How would you expect this to support you in the future?
For sure. In our particular case, the EIF, besides striking the balance between growth and default containment, access to capital, et cetera, for us it's a huge partner as we look to expand throughout Europe, right? I remember when we first closed last year, and we had many questions about the market, about areas of expertise, about regulation. Public institutions have been really key for us to sort of create a roadmap for the future and access pools of talent and knowledge throughout Europe, which has been incredible for us. And yeah, sorry, I don't have much more time.
No problem. One last one for Maite. Santander. Santander is specialized in startups, scale-ups. How are you specifically, or what is the differentiation that you are having in Santander Growth? How are you supporting scale-up startups, and how are you intending to support them even further? What is in the future for Santander Growth? What is next for you guys?
Thanks, Diego. Basically, for us, it was a challenge to speed up with SMEs, but of course with startups and scale-ups, as a commercial bank, used to analyze companies based on past closed accounts rather than on business plans. It's a major challenge where the guarantee has been very helpful. In startups and scale-ups, we have around 50% coverage with your guarantees, whereas in SMEs it's around 25% in funds such as Fondo Smart. So it's crucial. And it's, to close a sentence, I would say that it's time to speed up. Public-private collaboration has been key for us, but it's now time to speed up with all the challenges we're facing in Europe to make innovation more relevant. So thanks.
Very good. So thank you very much. Unfortunately, we're running out of time because I would keep on going. I find this so interesting, at least myself, that I leave the stage pumped up because at least we tried to convey, and I hope we succeeded in showcasing the possibilities that there are in public to public and public to private collaboration, the different possibilities, and that if you and your business can benefit from any of those examples, we would like you to look more deeply into this. We hope we were able to convey at least this message. These possibilities exist in the end, therefore the benefit of the economy, the businesses, specifically in the verticals we were saying, scale-ups, startups, innovation, digitalization, sustainability, those strategic focus. So I would encourage you to learn more about the institutions that were part of the panel today, and about the solutions that are available in the market. Because sometimes we, as entrepreneurs, we say, okay, but there are no opportunities, or there's no funding. I don't find the banks, I don't find the institutions, the investors that can support my business. And when I speak with the banks or the investors, they tell me the other thing. They tell me, listen, guys, I don't find the businesses. So let's approach each other, just check all of the options that are for financing, and hopefully some of them will be suitable for you as well. So thank you very much, everyone. Thank you very much to the panelists. It was really, really good. And hopefully we will see you soon, maybe next year. Thank you so much.
Thank you. Looking forward to seeing you all next year. Let's just take one final